Good morning, class. Today, we are going to finish up with IAS 36 and also start IFRS 5, IFRS 15. We can't finish it, but I know we're going to start it. So last week, we started looking at IAS 36 on impairment of assets. And the first thing I told you is the objective of this standard itself. And I told you that the objective of IAS 36 is to ensure that when you recognize your carrying amount, it is never higher than your recoverable amount. Your carrying amount should never be higher than your recoverable amount. If for whatever reason it happens that way, that your carrying amount is now higher than your recoverable amount, then that asset is said to be what? Impaired. And I told you that when we have carrying amount, it's just the amount at which an asset is recognized in the statement of financial position, depending on how you have measured that asset, either at evaluation model or cost model. And the recoverable amount is majorly the realistic value of an asset. The realistic value, which is usually the higher between the fair value less cost to sell and the value in use of that asset. How much can you recover from these assets, either from selling or from continuing to use these assets? Whatever is the higher, your carrying amount should never be higher than that. That's the objective of IS 36. In achieving that, we looked at how can you even know that an asset has been impaired. We consider indicators of impairment. We looked at the external indicators of impairment, and we also looked at the internal indicators of impairment. Then we looked at, okay, how do we then calculate recoverable amount? Because looking for indicators of impairment, what you are basically doing is impairment review. And this impairment review is either you confirm that there is actually indicators or you see that there are no indicators. But if you confirm that there are indicators of impairment, that means you then move to the next phase, which is impairment test itself. And it is at the impairment test stage that you determine the recoverable amount of the asset. And when you determine your recoverable amount, then you can then determine an impairment what? Loss. However, there are certain assets that even without indicators, you need to test them for impairment annually. Two of them. Number one is an intangible asset with an indefinite useful life. Number two is goodwill acquired in a business combination. Furthermore, we then looked at an example on how you determine impairment loss, and we also looked at the double entry. I told you that when you have an impairment loss, the double entry is just to debit the impairment loss to where? POL, and you credit the assets. However, if there is a previous, yes, you debit POL with the impairment loss and you credit the asset. However, if there is a previous evaluation surplus on the same assets, that means you will not debit POL directly, but rather debit OCI. If there is any excess, is that will go to where? POL. Of course, you credit the asset. That was what we discussed last week. For which one? Where there was a okay, I will. So I'm still going to teach you something on how to recognize evaluation surplus or deficit. So I will solve a lot of questions on that for you, but not in IS 36. If they want to ask you something like that, they won't ask it in under IS 36. They will ask it in under maybe IS 16 or IS 38. Okay, where there is a evaluation deficit this year and there is a previous evaluation surplus last year. So it's the same principle. So I'll still introduce you to something like that. Okay, so today now, we want to look at a situation whereby we have assets that we cannot determine their recoverable amount simply because we cannot determine how much they make individually. We cannot estimate how much you can make from them individually. And if you cannot determine how much you can make from an asset, that means you cannot determine its recoverable amount. The recoverable amount is how much you can make from an asset, either if you sell it immediately or you continue to use it. And a lot of examples of assets, we have furniture and fittings. You can't know how much you make from a furniture and fittings. You have air condition, you can't know how much you make from it. You have your laptops, a lot of assets in entities. You cannot individually see and say how much do we make from this individual asset. So it then makes it difficult for us to determine their recoverable amount. In such cases, it is required that you need to then combine a lot of assets together, that if they are together, you would be able to say, okay, together, this is how much they make. So when you do that kind of thing, then you are talking about a cash generating unit. When we have a cash generating unit, its purpose in life is to help you determine recoverable amount. As far as IAS 36 is concerned, when you see cash generating unit, CGU, its aim, its singular aim is just for you to enable us to impair those assets. And it is only when you have CGU that you can have recoverable amount. That is its aim. So when you see CGU, be expecting that they will give you recoverable amount of that CGU. And as soon as you have that, it has finished its job. Okay? So now, by definition, they say CGU is the smallest identifiable group of assets that generate cash flows largely independent of other assets. CGU, this is the smallest identifiable group of assets that generates cash flows largely independent of other assets. Now, please do. Yes?
The accountant, the management that assign what they generate that to each and each unit of the asset. Now, maybe assign um,
Asset to the unit.
yes.
So, I mean, your question is how do you then determine which asset belongs to what unit? Abi? Now, it is you as a company that will determine that, really. And practically, is usually, CGU is usually like a business. Okay? I mean, you have to, it's just for example now, you have like a branch of your business in a place. And in that branch, you have generator, you have furnitures, you have AC and all of this. You see, individually, you cannot get how much they make. So what we do is that we are going to see the entire branch, okay, all the assets in that business, everything together, because we know that it's only from that branch that we can know, okay, how much do we make from this branch, right? It's only that. So realistically, when you want to do CGU, it's usually the entire business itself, or it could be an entire building. Probably you have a building, and in that building you have elevator, you have air condition, you have fittings. So if you want to do impairment, you have to look at, okay, this entire building, we know how much we make as rent. So we can say, okay, let's take this entire building as CGU. And it could be, but in your exams, they would usually give it as a business. That, okay, this business, they will now give you the individual assets in that business. But the way you will know that what they are talking about is CGU, is that they will now give you a recoverable amount for the entire everything. So as soon as they give you that, just know that they are talking about a what? CGU. And they want you to impair each individual asset within that CGU. So CGU could be a business on its own. It could be whatever name you want to give to that unit, right? What is important is that can we identify how much this unit makes? Can we ask whoever is there and say, how much did you make today? Or how much did we make this month? How much did you make this year? And they can give us a response that this is how much we make. Then it's a CGU. Okay. Now, when you have identified a CGU, there will be several assets within that CGU. The examiner will give you recoverable amount. Of course, you will know its carrying amount. Then we would be able to determine impairment loss, which is where we are going. So let's assume the carrying amount of the CGU, let's assume is 10 million. And the recoverable amount, let's say is 7 million. That means there's an impairment loss of how much? It's 3 million. So this 3 million now, how do we enter it in our books? You debit P&L, Abi? What do you credit? Which asset? Exactly. So, because they are group of assets, Abi? And you know that in our books, it's not like there is an account called CGU. We just put them together purposely to get recoverable amount. But when you now want to enter this, now you have gotten what you want to get with the CGU. So you have debited 3 million to P&L. So how do you then split this 3 million among the assets? On a pro rata basis. Fantastic. However, IAS 36 prioritizes some set of assets within that CGU because we believe that some set of assets might have been the reason for that impairment loss. Yes, because when a group or a business is said to be impaired, something must have caused it. Is either its goodwill has been damaged, maybe one of your staff has misbehaved, and people have started dragging you guys on social media, or probably there is a physically damaged asset. There's a particular asset that is damaged. Something must have caused it. So for that reason, there's an order of allocating this 3 million. There's an order. And the first and the most important that we have to look out for is a physically damaged asset. You need to identify, is there a physically damaged asset? If there's a physically damaged asset, that you should allocate impairment loss to first. Then the next one is goodwill. Goodwill is the next one you prioritize because we believe that when we have a business, which is a CGU, and is impaired, if there are no physically damaged assets, another thing that will have caused it is the business goodwill. So the next that we prioritize is goodwill. So those are the two sets of assets that we prioritize when we are allocating this impairment loss. Number one is a physically damaged asset. Number two is goodwill. When you have identified those two, then the remaining impairment loss, you can then go ahead and impair them on a pro rata basis. The remaining impairment loss, you can allocate them on a what? On a pro rata basis. And that is how you allocate impairment loss to a CGU. Okay, let's open our packs. Let's solve two questions or three. Let's open our handouts. The last one, on a pro rata basis. Pro rata on a proportionate basis. Proportionate. Pro rata. Like this. They have not bought water. Oh yeah, let's open our handouts. Under CGU, the first question under CGU, the first question under CGU, under impairments, we are still on impairments. That should be 3.1. If it's under after CGU, 4.2. Okay. So who is reading? Hold on.
Minimart belongs to retail store chain Maximart. Minimart makes all its retail purchases through Maximart's purchasing center. Pricing, marketing, advertising, and human resource policies, except for hiring Minimart cashiers and salesperson, are decided by Maximart. Maximart also owns five other stores in the same city as Minimart, although in different neighborhoods, and 20 other stores in other cities. All stores are managed in the same way as Minimart. Minimart and four other stores were purchased 5 years ago, and goodwill was recognized. Required. What cash generating unit does Minimart belong to?
Okay. The question says that what cash generating unit does Minimart belong to? Having understood that CGU is just a unit, a business, a group of assets that we can trace how much it makes to it as a unit. Then, given this question, they said Minimart is a retail store, is among the retail stores of Maximart. So Minimart is just a supermarket. And you can see in the question, it's usually Maximart that usually buy all the goods, does all the marketing and all of that. So Minimart is just a store that you can walk to and buy. And of course, Minimart, you, if you are the accountant, you can easily know how much Minimart is making in a day. You can know how much is making in a month. You can know how much is making in a year. And when you have a unit where you can identify how much it makes, that is a CGU. To answer this question, Minimart does not belong to any CGU. In fact, Minimart itself is CGU because you can identify how much it makes. That's the solution to that question. The next question.
Okay, the next question. 4.4. Okay. A cash generating unit comprises of the following: building, plants and equipment, goodwill, current assets. The following a recession, an impairment review was has estimated the recoverable amount of the cash generating unit to be 25 million. How do we allocate the impairment loss?
How do we allocate impairment loss? How do we allocate impairment loss? The question is so direct. So, and they have already told us that those listings of assets they gave us is a CGU. And I've told you that the basis of allocating impairment loss is first you allocate to a physically damaged assets, then to goodwill, then to other assets on a pro rata basis. And that's exactly how we're going to do that. So the first thing we need to identify is that for this CGU, how much did they give us as the recoverable amount? 33 what? 25 million. And how much did they give us as the carrying amount? How much is in the impairment loss? So this 8 is what we want to allocate. Abi? So allocation of impairment loss. Allocation of impairment loss. So uh, what were the assets in this CGU? Mm-hmm. Okay. So how much is the building? The goodwill is 5. Yeah. The current asset is 10. So the total is 33. So the question did not tell us any physically damaged assets. Did they? But is there goodwill? How much? So we need to write this off to 0. So, but we have 8, Abi? And it's 1 and this 5, so we can give it everything. This becomes what? This becomes 0. Then remaining how much? Remaining 3 that we are going to allocate on a pro rata basis. However, the remaining assets are building. We have plant and equipment and current what? Assets. We don't allocate to current assets unless the examiner tells you to do that. Unless the examiner specifically tells you that the current asset has been impaired. Why don't we want to allocate to current assets? Because when you shake and look at this current asset, the items that will be there could be maybe trade receivables. And the way we impair trade receivables is quite different. We only impair the trade receivables where, in fact, we impair it through an expected credit model under IFRS 9. It's quite different from how we have determined this impairment here. Also, this current assets might include maybe inventory. The way we impair inventory is different in IAS 36 because that is done using IAS 2. So, and some other financial assets like that. That is why we will not allocate impairment loss to the current assets because the way they are impaired is quite different. Unless the examiner specifically tells you that this current asset has also been what? Impaired. Then you can then go ahead and allocate to it. But they didn't tell us that here. That means the remaining 3 million impairment loss is going to be shared between the building and the plant and equipment based on their relative values. Based on their values. Okay? So for the building, when I'm listening to you, go ahead. I'm listening to you. I just explained that. I just explained it that the way we impair current assets is different from the way we do impairment loss here, right? Because this could include inventory, that the base of impairment is different. It could include trade receivables, the base of impairment is different. So you only impair current asset along if the examiner specifically tells you to do that. Otherwise, you will not do it. So this is how much? 2.5. What about the plant and equipment? That's this 3. 3 over 18 times what? And that's 500. So this is 2.5. And what? So what's 15 minus 2.5? What's 3,000 minus 500? Then this remains how much? A total of how much? A total of? A total of 25. Okay. Now, let's go to past questions. But before I go to past questions, I need to quickly bring your attention to something. I hope you know that impairment is a permanent loss in the value of an asset. For you to ascribe an item as, that's the difference between revaluation deficits and impairment loss. Revaluation deficit could be maybe as a result of fluctuations in the market prices, then valuation deficit, revaluation surplus. But when you mention impairment loss, it is a permanent loss in value. Is a permanent loss in value. So take note of that. However, it's possible for a reversal. It's possible for a reversal. Like a physically damaged asset now. It could happen that it's now repaired and is working maximally. They have spent a lot of money on it and is now doing well. So the impairment might what? Might reverse. They might resuscitate it. But if your goodwill is impaired, that's the end. It cannot be reversed. Goodwill that is impaired cannot be what? Reversed. So take note of that. So if, let's say, you had an asset whose value is 10 million. Are you with me? You have an asset whose value is how much? It's 10 million. You then impair it. You said it has impaired by 2 million. So you bought it to its recoverable value amount of 8 million. So one thing or the other happened. You said the impairment has what? Reversed. It now reversed to 12 million. That means there's a revaluation surplus of how much? Of 4 million. What will be the double entry of that 4 million? Double entry. You credit PL, yes. Debit what? So, I mean, you need to tell me properly, what are we doing? Oh, yeah? You debit PL with how much? The 4, yeah. OCI. You debit OCI with how much? With the same 4. Okay. Debit P&L 4. Debit OCI 4. Okay. What are you debiting again? Okay. You credit P&L with 4 million. You credit OCI with 4 million. You debit the assets with how much? 8 million. So where did you get that 8 from? Okay. There will be 8 in the account already. Okay. You debit the asset with how much? No, you are only increasing the asset from 8 to 12. So if you are debiting the asset with anything, it will be with 4. Yeah. Yes, reversal of impairment. You debit the asset with 4 million. With how much? 4 million. Wrong. See, you debit the, we know we are debiting the asset with 4 million. That one should be clear because you are increasing the asset from 8 to how much? So 4 million. However, you are going to credit P&L with 2 million. Ordinarily, surplus should go to OCI. Surplus should go to where? OCI. But because there was a previous impairment loss of how much? That is the only reason why this one is going to P&L. Otherwise, we will have credited everything to OCI of 4. So we credit P&L with 2. Just because there had been a previous impairment loss of how much? 2. Then you now credit OCI with how much? I'm still going to teach you depreciation and revaluation around second week or first week in October. Depreciation and revaluation. So I will teach you how to, just a revision for you, because it's assumed you know this, but I will intentionally teach you how to calculate depreciation, how to get revaluation surplus, all of those things. I will just come to class and teach you within that 2 hours that we have. But for this one, this is how you treat it. But you see, IAS 36 says that this cannot apply here. Where there is impairment loss, this cannot apply here. Because impairment loss is a permanent diminution in value. So if there is even any reversal, this value cannot be more than the original value before impairment. It's not possible. It's not possible. I want them to see. It's not possible. So this 12 million that is here, okay, It will not be allowed. When we are reversing this impairment, we can only reverse back to what? To 10 million. So this OCI thing will not even happen because you cannot reverse beyond the original value. We believe you want to create your account. You just want to do a juro. So you have to debit the asset with 2 and credit P&L with how much? 2. That is how it works for reversal here. What do you say? You what? Yeah, it's gone. It's gone. So what will be in your books will be 10 back. It cannot be 12. Yes, please.
Even concept under IAS 16, like completization, like when you spend like a capital item on an asset that has been existing, to make it come back to functionality or blah blah blah, and we need to capitalize that. Is this somewhere related
No,
to
it's not.
that example?
No, it's not. That one is different. That one, you are talking about subsequent costs, okay, that you capitalize. That one is something else entirely. It has nothing to do with what we are talking about here. Okay, and it's not even componentization. Componentization is also different, right? Okay, okay. So that is it. Let's solve two past questions. Let's solve two past questions. Let's go to the past questions part. There's one, I'm solving one question from skills level because I think that that question we can still learn a lot.
That's for school.
Yeah.
Let's go to the problem now.
Okay. And we're going to solve one at the professional level too. Okay. So I'm solving two questions here now. So, but there are a lot of questions. A lot. In fact, the one I'm solving here is like the most difficult so far. But there was one they asked, the diet. It was simple, but it's a challenge. It's a challenge, especially when you want to determine value in use. So, when you want to determine value in use, they will give you future cash flows. Then you then discount it to present value. Do you know what the examiner did? They gave you
The present cash flow.
pre-tax cash flow and post-tax cash flow.
Yeah.
They gave you pre-tax discount rates, post-tax discount rates. And as a calculating payment loss, it's simple because all you have to do is just, they already gave you fair value less cost to sell, calculate value in use, get your impairment loss, and of course account for it, debit this, credit the asset. So the major challenge is which cash flows are you using? Is it pre-tax or the post-tax? So which if you were in that hall, which one would you have used?
Post-tax. I think it's
And that's
post-tax.
correct. That's correct. So why did you use post-tax? Why did you choose post-tax? Because you will have been correct
Correct.
if you had used post-tax. But why did you use post-tax?
So the kind of that we use for investment is considered after tax.
Okay, that was the basis of your decision. Okay, so for us, for value in use, you see, the idea of value in use is an idea of net cash flow. It's an idea of how much are you making from these assets after all encumbrances and expenses have been deducted. What is remaining for us? That's the value in use. What we can make from these assets at net. Okay, so that's why it's going to be the post-tax interest rates, the post-tax. So I say interest rates. Yeah, the discount rate will be post-tax, and the cash flow also is going to be, yeah. And the question was for 10 marks. 10 marks. Impairment. Okay, so but the one we are solving, let's start with that one of skills first. Let's solve that. Please wait.
Okay. Question 7.1.
Page 100.
Page 7.1. Question 7.1. As a result of privatization and commercialization exercise currently ongoing in the country, the Ministry of Transport sold the assets and liabilities of a newly constructed standard um, gauge railway to a private company called S- Statlos Rail Limited to ensure smooth operations of the railway services by freeing it from government bureaucracy. The summarized extract of the financial position of at fair value of SRL as at January 1st, 2019, reflecting the terms and conditions of the sale agreement of the Transport Ministry are as follows. All figures assume correct. The operating license is for a 10-year period, which was issued which was issued on January 1st, 2019 by the Transport Ministry, and it's stated at cost. The carrying value of of the property and rail track and coaches are based on value in use. The engines are valued at their net selling prices. On February 1st, 2019, one of the train machines got damaged due to technical faults from the manufacturer and the engine was completely destroyed. The sale of the assets to SRL was without recourse to the transport ministry and the manufacturer of the engines. In view of this, it was estimated that there would be reduced passenger capacity. Therefore, the estimated value in use of the whole train service business of SRL was assessed to be 1.5 trillion. The number of passengers after after one of the engines of the train got damaged was below expectations, even following even allowing for a reduced capacity. In the in light of this, the value in use of SRL rail services was reassessed in on March 31st, 2019 to 1.35 trillion. On this date, the SRL received an offer of 675 billion from another company called Papaya Railway Services Limited for operating license since it is transferable. The realizable value of the assets has not been changed significantly. Required. Draft a memo addressed to the MD of SRL explaining the basis of allocation and impairment loss to the assets of a cash generating unit in accordance to IAS 36 on impairment of assets. 6 marks. B. Calculate the carrying amount of the assets of SRL on the 1st of February 2019 and 1st of March 2019. 10 marks. C. Explain two conditions that must exist before an impairment loss can be reversed. 4 marks.
So good question. You will see that we will learn a lot from this question. So let's see what we can do in 10 minutes. So the first part of this question is draft a memo. Okay. Hardly do they ask you guys to draft a memo now. They only ask you to advise or do a report, something like that. So for them, drafting a memo is just that template of a memo. Probably you write the name of the company, from, to, date, the subject, then whatever. Then after you have written, then you write what after your subject, you write whatever you want to write. Then you write your name and sign out. That template alone will give like 2 marks out of that 6 marks. So the remaining 4 will be the basis of allocating impairment loss. So what's the basis of allocating impairment loss? The first is to physically damaged assets. The third is to other assets on a pro rata basis. I need one more point to flesh it up. Thank you very much. Thank you very much. Don't allocate to current assets except it's specifically mentioned that it is what? It is impaired. Don't write by the examiner in your letter. Okay? Except it's specifically identified as what? Impaired. Then you're done. Now, the second part of this question is asking us to determine carrying amount in February and in March. Abi? In February and in March. You see, the surprising thing about this question, why it was interesting is that this diet, a lot of students didn't even know that what they wanted them to do is allocation of impairment loss to CJU. They didn't know because nothing was mentioned in the question that shows that it's a CJU, except you understand it. Because if you look at the first paragraph of the question, The first paragraph is saying government sold a railway station to Stalos. That was the first paragraph. Then the next thing they told us is the assets of that new railway station of Stalos. They gave us all the assets, and they also told us the purchase consideration of 2.2 billion, which is the addition of the old asset. Then the next paragraph then gave us some analysis that the license is at cost, the rail tracks and whatever is at value in use, the engine is at net selling prices. The next paragraph now told us that something now happened in February 1st, 2019. One of the train engine got what? Damaged. For that reason now, they now gave us the value in use of the entire train station. That is the only way you will know that what they are talking about is a CGU. That is the only way, because they gave us the value in use of the entire business. That is the only way. So as soon as they gave, okay. So that means the business itself has been what? Impaired. Because the carrying amount of the business is 2.2 and the recoverable value is how much? 1.5. There's an impairment loss of how much? 750. Or 750 from 2.250 to 1.5. There's an impairment loss of 750. So 750, you need to allocate it to those assets in the order we have learned. That one. In the next paragraph, they told us that things are not still going fine. So in March, the value in use of the entire train station is now how much? 1.350. Further impairment from 1.5 to 1.350. They now went further in March that, okay, since everything has scattered, somebody now came that wants to buy the license. For how much? 675. And that was it. Very simple question, though you need to understand it very well to attempt it. So let's quickly do the carrying amount in February and in March. So in February now, the carrying amount of the assets at February 1st, 2019. So, what were the assets given to us in the question? Goodwill. How much? 150. Yes. Operating license. 900. What again? How much? 225. What again? Rail tracks and coaches. How much? 225 again. What again? 2 train engines. 750. What again? That's all. So what's the total? Oh, they have already given us in the question 2250. Abi? And they give us the recoverable amount to be how much? That means there's an impairment loss of how much? There's an impairment loss of 750. So let's allocate the impairment loss. So when allocating impairment loss, you allocate first to what? Was there any physically damaged asset here? One of the train engines. So how much are we allocating? How much are we? Yes. Fantastic. Which is how much? 375. So that means the carrying amount becomes how much? Then next to what? Let me put the total here. How much is going to goodwill? This becomes what? Then the remaining. How much impairment loss is remaining? Let me do the calculation. 225 is remaining. Then the remaining is going to be allocated to the remaining asset on a what? On a pro rata basis. So let's pro rata it. the operating license first. How much? Divided by what? Times what? How much is that? Okay. Then the property, 225 over what? Times what? How much is that? Then how much? 37 what? So 150, 37.5, 37.5. So 900 minus 150 is how much? 225 minus 37.5 is how much? Hmm. Intelligent. Thank you for asking. So why did you then give me 1350? Intelligent 30. Okay, we won't consider it. We should have considered it. We should have. I thought you won't ask, but you guys are intelligent here. You actually figured it out. So the reason we won't have considered it is because when you are impairing, when you are impairing, you are only impairing to recoverable amount. Abi? You are bringing down the asset to its what? Recoverable amount. However, some questions will have already given you that at the asset present state, at that carrying amount is already its recoverable amount. And that's what is happening to this train engine. If you look at that second paragraph, they already told us that the two train engines are at their net selling prices. They already told us that the two train engines are their what? Net selling prices. When they tell you, when they give you the net selling prices of an asset in a CGU, you do not impair further beyond that. Otherwise, you will defeat the objective of impairment loss. The objective is that don't let your carrying amount be higher than your recoverable amount. Let it be that. Okay? So they already told us that the engine is at their what? Net selling prices. That is the realistic value. Don't bother impairing further. And that is why I kept quiet when you did not consider this. Even I know that you don't even know why you didn't consider it. It was an omission from your end, but accidentally you were correct. Okay? The reason is that this 750 is at their net selling price. The only reason why we entirely impaired this damaged asset was because it's damaged. It's gone. It's destroyed completely. Okay? You see this remaining one, you will impair it further because that's the what? Net selling prices. Watch out for that in the exam. When they give you the market value of an asset, don't impair below that. Leave it at that. Bring the asset to its what? Market value. Good observation. So 225 minus 37.5 is how much? Sorry? And this one? So a total of how much? Okay. So that's the carrying amount. That's carrying amount in February. Now let's do the carrying amount in March. Sorry. So the assets as at February, we bring them forward. We don't have goodwill anymore, but we have operating license. Abi? The license is now how much? 750. Then there's property. How much is the property? There's rail tracks. How much is the rail track? And there is now one train engine, which is how much? So a total of how much? So this is the carrying amount. Abi? What's now the recoverable amount now? Which brings it down the impairment loss to be how much? Impairment loss is 150. So let's allocate this impairment loss. Is there any physically damaged asset here? Is there any goodwill here? That means we need to allocate on a pro rata basis. Firstly, I know that I'm not allocating to this guy. Definitely, it's at its net selling prices. You can't allocate further. You can't impair further. This is 150. The same thing will apply to the license because they already told us the market value of the license. And what's the market value of the license? Just bring it down to 675 because that is now the realistic value. Bring it down to how much? So out of this 150 now, how much are you allocating to this guy? How much are you allocating to this guy? Yeah. So the operating license, they already gave us the market value that somebody came to buy it for 675. 75. 750 minus what? 675. Remaining how much? Since these two are equal, that means you share the remaining equally. Abi? 37.5 and what? So this is 150 and this is how much? So brings it down to how much? 10 marks. As simple as ABC. No thinking is required. Just like pure order. When you want to open your pure order. Why not? Skills. They can ask it here too, surprisingly. They can ask it here also. Which one? Which 150? This one? This one? So the recoverable amount as a March is 1,350. And the carrying amount is 1.5. There's an impairment loss of 150. What's time? We are below time because I need 1 hour for IFRS 15. What's the C part of this question? Okay. What are the two conditions? That's correct. That's one. Remaining one.
Yes, you see that the reversing should not be more than the original.
That's also correct. These are the two conditions. Okay. When there is a positive indicators of impairment or when the value of the asset has improved, that's one. Number two is the reversal must not result in a value that is higher than its original amount before impairment. The new value of the asset, the reversal must not result in a value. The reversal must not result in a value that is higher than its original value before impairment. The reversal must not result in a value that is higher than its original value before impairment. Hmm? Should have up to 1 hour. Okay. That means I'll give you the second question as assignment.